Welcome back to Fairways to Finance. Today I have a special guest, Logan Ruthling, who's joining us. Logan recently joined Mason Borough Advisors about 3 months ago, and Logan brings with him a wealth of knowledge from a CFA standpoint. He is a chartered financial analyst and has extensive knowledge in the private markets, and that's what we're going to talk about today. Logan, thanks for joining us.
Of course, happy to be here.
Likewise, and we're happy to pick your brain on the private markets because so many of our clients and really just friends and peers of ours are digging into the private markets, trying to discern what are they, right? What are the private markets? How can we, as individual investors, those that are watching, gain access to these types of investments?
Sure. So let's just break that down and to keep things as simple as possible. Private markets. What are private markets? When we say private markets, we're talking about private businesses, right? So think like Chick-fil-A or Publix Food Market, Ashley's Furniture. There are a ton of companies like this all throughout the United States. In fact, here's a little tidbit for you. I didn't know this until about a couple years ago. It's like over 80% of companies in the United States that make over $100 million in revenue each year are private. So
Wow.
Most of the companies that earn over 100 million in revenue each year are private businesses, which is kind of interesting to think about.
That is interesting. And so for those that are looking for that exposure, right? Most people, when they think about investing, they're talking about the public market,
Right.
right? And so I think, and you recently shared with me a statistic about private companies staying private longer.
That's right.
And then
Yep.
investors themselves, once the companies, if they choose to go public, the investors are missing out on so much of that upswing because they're still private. So are you suggesting that this is an opportunity for investors to gain access to that exposure in the upside?
If it makes sense for the investor, then absolutely. I mean, there's been this trend since the 1980s for companies to stay private for longer. So basically, the amount of time that it takes for a company to go from inception to IPOing or going from being a private company to the public markets through an IPO, that process measured in years has grown. So it's gone from like anywhere from 5 to 10 to over 10 years. And the transaction value of IPOs, so what value are these companies coming to market at when they transition from the private markets to the public markets, has also increased significantly. And what that means is that more of the value creation on the equity side for the value of these businesses is happening while the companies are still private. When you look at like Uber and Lyft, for example, are great examples of companies that stayed private for a very long time and didn't go public until around like 2019 and 2021. But that is a trend that we're seeing. And for investors that are currently invested in like stocks or bonds or the S&P 500, all those companies, most of them were at one point private, right? So if you are interested as an investor in getting exposure to the full life cycle of U.S. companies when they're private and then when they're public, there is a way to do that.
For someone that's interested in the private markets or curious to explore more, can you explain how the private markets or private investments, private equity, private credit, whatever that may be, how that fits into somebody's portfolio?
Sure. So basically, there are different allocations that you can get to the private markets, and that kind of depends on the investor. For example, large institutional investors such as endowment funds or pension plans that run portfolios for the state of Carolina or the state of Texas, they're going to have different objectives than like your typical high net worth client, right? In terms of what they're trying to accomplish with the portfolio. Typically, those portfolios, those allocations are more illiquid, right? They don't have as many liquidity needs as, say, maybe somebody who's saving for a house or a down payment or needs to pay their kids' tuition and endowment doesn't need to worry about that. So they might be allocated, 20, 30, 40% of the portfolio in these illiquid types of investments. But for a high net worth individual or someone who's looking for exposure to these type of assets, it could be 5% of the portfolio, or up to 15 or even 20%. So it sort of just depends. And in terms of sort of the benefits, typically, historically speaking, private credit and private equity have exhibited a lower correlation of returns to stocks and bonds. And basically what that means is that when the stock market goes up 15, 20%, private equity might only go up, 10. But on the downside, if the stock market goes down 20 or 15%, private equity might only go down 5%. So there's typically in a portfolio, you don't want to have everything doing the same thing, because that's going to make your portfolio a lot more volatile. So if you can have different assets in the portfolio that will do well in certain times in certain markets while others might not do as well, the overall return gets smoothed out. So you're able to make money over longer periods of time.
Right. Yeah, and I think we were talking about a private credit strategy, and we won't share the name, but last week we were talking about one, and the standard deviation of that particular interval fund we were discussing was so small that I think really just proves your point of being less correlated to the overall public markets could add some alpha to a portfolio, right? Whether that be an endowment or even just a high net worth individual that's looking to further diversify and drive performance.
Exactly. Oftentimes when you have a portfolio of publicly traded bonds or high yield or fixed income or whatever it is, having some private credit can usually enhance the yield and also reduce the volatility in the portfolio as well. So there's a lot of benefits to adding private credit to a fixed income portfolio, and the same with private equity to a portfolio of just stocks.
So if we're continuing this conversation where someone's thinking they may be interested in some private market exposure, how would an individual, a high net worth individual, go about investing in the private markets?
Yeah, it's a great question. In the past, investors would mostly get exposure through what are called drawdown funds. So a drawdown fund is basically a manager, say like Goldman Sachs or BlackRock or Blackstone, says, we're going to need you to commit anywhere from $250,000 to $5 million to invest in our private equity fund or our private credit fund. And then that $250,000, let's call it, is called over a period of, it could be a couple of years, in increments, right? So the investor has to keep cash in a bank account. They don't know when it's going to get called, but that money is drawn down over time into the fund, and that's why it's called a drawdown fund. Those funds, depending on what kind of what the asset class is, the lockup periods could be anywhere from like 8 to 15 years. And a lockup period is just the period of time where you can't get your money out, right? There's no liquidity for the investor. So there were high minimums, capital calls, long lockup periods, and that's historically how it was done. And because of those characteristics, typically only like the top 1% of Americans and institutional type investors, like the ones on Wall Street, were able to invest in these asset classes. But there's this new term on Wall Street. Well, it's not several years old, but it's called the democratization of alternative investments. And what's a democracy? It means freedom to everybody, right? So basically today, investors who wouldn't necessarily fall in that 1% category can get exposure through what are called interval funds. So this is different from a drawdown structure, where these are funds that are registered with the SEC, so they're regulated. There's full transparency on what they're investing in, their fees. There are documents that have to be disclosed each quarter by these companies to the public. So there's a lot of transparency, but liquidity is made available in intervals, so in periods. So for example, many funds will make a percentage of the fund available for investors to sell their shares each quarter. So if you have an investment in an interval fund, you might be able to sell your shares of the fund like every 3 months, right? So it's not every day like a stock, but it's also not 10 years
Right.
as well. So there's still that illiquidity feature, but it's much more investor friendly. Also, your money is not called over time. It's invested on day one. So your money gets planted in the ground and starts growing for you, starts working for you. And the minimums are also much more accessible. It's not 250,000 to 5 million. These days, you can get exposure to as low as like $2,500
Right.
minimum investments. That's not, most cases it's closer to like, it could be anywhere from like 2,500 to 50,000, but
Right.
it's much more investor friendly these
Right.
days.
Hence the term, the democratization
Exactly.
of alternatives.
Yeah. Whoever
So-
came up with that was clever.
Yeah, that was a good idea.
Yeah.
So when I'm thinking about who this might make sense for, right, my brain goes to clients in the past, and people have always said, "Oh, well, do I have to be an accredited investor?" So is that something someone has to be to invest in one of these private markets, or who does it make sense for?
Sure, a great question. It depends on the fund. There are many different types of interval funds out there managed by many different types of companies and managers, and they all have different requirements. If you work with a financial advisor, definitely ask them to look into that for you. They would know. Oftentimes, though, especially for private equity interval funds, you do need to have a certain net worth, or you need to be making a certain annual income. And that really is just for the investor's protection, because these are illiquid assets, right? So typically they have that requirement because a portion of your portfolio that's going into an investment like this, you really, even though there is more liquidity, this is something that you need to think of as like, this money is locked up. It's going to be earning higher risk adjusted returns and adding diversification to my portfolio, but there's a trade-off for that, which is less liquidity. So typically investors that have, certain characteristics are better able to, stomach illiquidity, if that makes sense. So that's kind of why they have those restrictions in place, just for the investor's protection.
Yeah, no, I think those are good points. When someone's thinking about evaluating these types of investments, should they be working with an advisor to have some assistance in identifying maybe what are the better types of private investments to focus on?
Well, I think I'll use just this analogy. I mean, would you go to like a patent attorney if you got a speeding ticket? No, probably not, right? You'd want to get a traffic attorney, right? So there are many different types of advisors out there that have a lot of experience and can advise you on different things. So when you're thinking about making an investment in the private markets, you want to make sure that your advisor has background in investing in the private markets. There are certain designations that you can get to learn more about the private markets, and you can ask your advisor if they have any of those. How many years of experience do they have looking at different private market investment managers or assets. If they do have experience, a good financial advisor can save you a lot of money, because in the private markets, there is a much wider dispersion of performance, meaning that the best performing private market managers outperform the worst performing by a lot more than the best performing managers in the public markets compared to the reason for that is because typically information in the private markets is much more restricted. It's harder to get information, and that information gives the really good managers an advantage and allows them to consistently outperform. The other big thing is fees. A lot of people don't spend enough time looking at what they're paying when they invest in interval funds. If you go through the prospectus of each interval fund, it's like a 200-page document. There is a section that covers summary of fees. And many times all of those fees that are listed on there are not showing up on the one-page fact card that you're going to be given. So it's important to go through and look at what you're actually paying, because that's coming out of your return.
Right, exactly.
So, and a good financial advisor will basically know which funds are maybe overcharging, or it's basically helping you avoid some landmines.
Yes.
If that makes sense.
And always improving performance, right? Or
Yes.
likely upside participation.
Right.
Logan, when people think about private markets, and you touched on it a little bit about the illiquidity feature of interval funds, or a lot of the drawdown private investments that we've seen clients in, right? And quite frankly, much to their dismay, they can't really get their money out.
Yeah.
So can you speak on some of the private market investments that you focus on, and how a individual investor might have access to getting their money out if they wanted to?
Sure. So the types of funds that I look at, I try to always make sure that the manager that we're working with has a very good and long-term track record, that they are that manager that for 20 years has been on the far right side in terms of they're the best performing ones. I make sure that the managers we're working with, how are they being paid, right? It's important to know what their fees are, how they're being compensated, and make sure that their interests are aligned with the interests of our clients, their investors. We want to look at the liquidity that is being made available to our clients in case they do want to exit. So the type of fund structure, is it a drawdown fund? Is it an interval fund? There are other different types of funds as well that we didn't cover, but there's a lot of nuances there, and interval funds, in my opinion, are the best in terms of offering liquidity to investors. So when we're going through and kind of screening through the hundreds out there, these are the sort of things that we look at. We want to make sure that we're finding managers that are earning high returns but are taking a more conservative approach that kind of fits with Mason Burrow's investment philosophy. We don't think that you should be taking an extreme amount of leverage or debt in order to drive performance. That performance should come from just the quality of the management team in making investments. And because using leverage, that adds a lot of risk. And a lot of times managers that use leverage will pass along those costs of borrowing to their end investors, which is something that a lot of people don't know, which is in that 200-page document I mentioned earlier. So these are the sort of things we look for. And in terms of getting your money out, I mean, it's going to be the easiest to do that with an interval fund. With a drawdown fund, that would be something that you would need to reach out to your advisor or I guess wholesale rep at the firm that you have your investment at. They may be able to get you liquidity. A lot of times that's pretty just subjective.
Yeah. Okay. Well, good stuff. I think we covered a lot today. We don't want to overwhelm anybody that's watching, but if you have any questions or want to just pick our brain, specifically Logan's, on what sort of investments are available to you, what that looks like from a liquidity standpoint, maybe a fee standpoint, as well as a performance standpoint, right? That's what all of us are after.
Yep.
Feel free to reach out. If you have any comments, feel free to share them on this video, and we'll make sure to do another video soon to bring some more information. Thanks for watching.
Thanks.